Seeing your portfolio in the red feels terrible, but what if this is actually the moment that separates successful investors from everyone else? Every major market downturn teaches the same lessons, but most investors only realize them after they've already lost money.
Let's talk about that feeling. You know the one. That sinking pit in your stomach when you open your portfolio and just see a sea of red. It is tough, no doubt about it. But what if we could take all that anxiety and turn it into some serious, hard-earned wisdom? Today, we're going to break down the painful lessons from this last market downturn into 5 super clear rules that can honestly make you a smarter, stronger investor for the rest of your life. All right, let's get into it. So let's just start with a really direct question. Go ahead and think about your portfolio. How's it looking right this second? Are you seeing more red than you'd like to admit? I know it can be painful to even look at, but it's important. Because if the answer is yes, there's something you really, really need to hear. You are absolutely not alone, not even close. A recent poll showed that a huge number of investors are in the exact same boat as you. So that pain you might be feeling, it's a shared experience. This isn't about something you did wrong. It's about a market cycle that's teaching all of us some brutal but incredibly valuable lessons. And that brings us right to our very first lesson, the myth of the permanent profit machine. Because for a little while there, it really did feel like investing was easy, maybe a little too easy. I mean, think about it. For anyone who started investing after the 2020 crash, the market felt like some kind of magic ATM. You put money in, and boom, more money came out. It seriously felt like you just couldn't lose, which created this really dangerous sense of security, especially for new investors. And this wasn't just a feeling. The numbers behind it were staggering. After that 2020 crash, the Nifty 50 index nearly tripled in value. That is a historic, massive run that made that magic ATM feel very, very real. It basically conditioned a whole generation of investors to think that this kind of insane growth was just normal. But here is the big, unavoidable truth. No machine can run that hot forever. It has to cool down. The market doesn't just go up in a straight line. It moves in cycles. A bull market is always followed by a correction or a bear market. It's not a bug, it's a feature of the whole system. And just accepting that fact is the first real step to becoming a long-term investor. Okay, so if markets move in cycles, can we just predict when they're going to turn? Well, that leads us right into lesson number 2, the futility of forecasting. Just take a look at this. Near the market's peak in late 2024, a major, well-respected analyst went on record saying the Nifty would go straight to 30,000. Total confidence, right? And what happened almost immediately after that prediction? An 11% correction. Not just wrong, spectacularly wrong. And listen, this wasn't just some one-off mistake. Think about the biggest market shocks we've lived through. The 2008 crisis, the crazy COVID crash, the global sell-off in 2022. Pretty much nobody saw them coming. The lesson here is so simple. If the experts with all their data and resources can't predict this stuff, we as retail investors shouldn't even try. So what's the actual answer? It's beautifully simple. You have to tune out the noise. Ignore the breathless headlines, ignore the hot tips on social media. The most reliable, stress-free path for most of us is just to invest systematically. You know, in SIP. Put in a fixed amount on a regular schedule and just let it ride. It takes all the emotion and guesswork right out of the equation. But what about that feeling you get when it seems like everyone around you is getting rich quick? This pulls us deep into our third lesson, a really powerful emotional trap we call FOMO. You've probably heard the term, but let's break it down. FOMO, the fear of missing out, is that pit in your stomach you get when you see some stock or asset just shooting for the moon. You hear stories of people making a fortune, and it creates this powerful psychological pull that screams at you to jump in, often at the absolute worst possible time. Let's look at a classic example with gold. Okay, so the price starts climbing. By May, it hits a new peak, and the media hype is just deafening. Everyone's talking about gold. That's when the FOMO kicks into high gear. In June, a flood of investors buys in, terrified of missing the rocket ship. But what happens in July? A sharp 9% correction. And all those investors who bought at the very top, they panic, and they sell at the bottom, locking in their losses. It is a textbook FOMO trap. And this really brings us to one of the most fundamental rules you'll ever learn. FOMO is an emotion. Investing is a plan. You can never, ever let the two mix. The second your emotions hijack your plan, you are setting yourself up to fail. You know, this ability to keep your emotions separate from your plan is exactly what divides investors into two very different groups. And that's our fourth lesson. So when a market crash happens, two types of people emerge. On the left, you've got the emotional investor. They see disaster, they panic, and they sell everything at a low price to stop the bleeding. They've just guaranteed themselves a loss. But then, on the right, you have the disciplined investor. They see the exact same crash, and they think one thing: discount sale. They see quality companies on sale and calmly buy more, setting themselves up for huge gains when the recovery comes. This whole mindset is just perfectly captured by Warren Buffett's legendary advice. The entire game is to train yourself to be the investor on the right side of that slide, the one who gets greedy and sees opportunity when everyone else is completely freaking out. That is how real, long-term wealth is built. But to actually be greedy when others are fearful, well, that requires one last absolutely essential ingredient. And this brings us to our fifth and final lesson: the incredible power of patience. Look, in the short term, the stock market is basically a gambling machine. It's a casino. Over any given one-year period, your returns are a total coin flip. You could be up 50% or you could be down 30%. This is why if you invest money that you think you'll need anytime soon, you're not really investing, you're just gambling. But now, watch what happens when you just zoom out. When you stretch your timeline to 10 years, the market transforms from a gambling machine into a wealth-building engine. Historically, get this, there has never been a 10-year period where the Nifty 50 delivered a negative return. Time is the magic ingredient. It smooths out all those scary drops and turns short-term risk into long-term reward. Okay, so let's put all 5 of these lessons together. Here are 4 simple steps to build a portfolio that can handle any storm the market throws at it. Number 1, accept that corrections aren't just possible, they are normal and expected. 2, invest systematically, ignore the daily noise. 3, actively reframe downturns in your mind. They are opportunities, not disasters. And 4, this one is critical, only invest money you are absolutely certain you will not need for at least the next 5 to 7 years. So we'll end on this thought. Another market correction, another sale, isn't a matter of if, it's just a matter of when. The lessons from this last downturn were definitely brutal, but they were also a gift. They've given you the knowledge and the framework to prepare. So the only question left is, when that next big sale does arrive, are you going to be panicking with the crowd, or will you be ready to shop?
Here's the twist: the easier the market feels, the more dangerous it usually is. Short-term investing feels like a game of skill, but most of the time, it's just disguised gambling. If you want to be the investor who wins in the long run, subscribe, because success in the market isn't about avoiding downturns, it's about knowing how to act during them. And the next time you see red in your portfolio, ask yourself, am I reacting, or am I following a plan?